obviously proven too. So with that being the goal of buying more properties, really the only way of doing it was to take investors' money and get into that whole syndication route of now we're not just looking for deals, we're also now we have another, kind of plate to spin too, which is also finding investors and working with investors to buy properties that we're already investing into and see if they want to join us in those.
Welcome to the Stephen Lee Thomas Show, where we provide expert advice for real estate entrepreneurs. And I'm your host, Stephen Lee Thomas. And it wasn't that long ago that I was navigating the challenges of real estate investing, learning from my mistakes, and building the business I have today. I created this show to give you simple, actionable, step-by-step strategies to help you do the same. Each week, we bring you in-depth discussions with industry leaders and professionals who share their knowledge and practical tips. So sit back, take notes, and let's dive into today's episode. Welcome to the show. I'm your host, Stephen Lee Thomas. And today's guest started multifamily investing or commercial real estate investing back in 2006. So it's been a while, knows a few things about commercial real estate investing. He's been able to invest in over $200 million in commercial real estate. That's over 3,000 multifamily units. And I'm going to give him a shout out for this. He's an Eagle Scout.
Yeah.
And that's important to me because I'm an Eagle Scout as well. And I don't come across a whole lot of Eagle Scouts. So a lot of great accomplishments there. I would love to learn if becoming an Eagle Scout helped pave the way for your path there. But today's guest is Charles Carillo. Charles, thank you so much for joining me today.
Yeah, thank you so much for having me on. It's great to be here.
Yeah. So Charles, tell us a little bit about you and where you're at right now.
Yeah, so I'll give you a quick background on myself. I'm originally from Connecticut. I live down in South Florida now, Southeast Florida. And I grew up in the real estate business. My dad was, he bought his first rental property a few months after I was born, a six-family property. And he and another partner, they built up like 100 units of properties portfolio. And that was mainly like, well, to be nice, let's say like C minus class, but it was really tough properties like D, C, C minus class properties. And it was like, and that was kind of like my second education of spending time there in elementary school, middle school, and ultimately high school, going back and forth to properties. My dad self-managed them. He had a small team that he put together. It's very difficult to hire property managers to effectively manage D-class properties, C-minus properties. It's a very tough locations and a tough demographic that you're working with mainly. And that's not just tenants, that's also everything else that goes with it. So, I learned that, and it wasn't anything I wanted to really get involved with, but my dad kind of started buying better properties as he kind of before he started selling his properties in the late 90s, early 2000s, and that's what I did. So when I graduated high school or college, my dad really pushed me to buy my first property. It was a three-family property, as we call now house hacking. Lived on one floor and rented out the other two. And then bought another one of those about a couple blocks away in 2008. It was the end of 2008. So if anybody was around the end of 2008, I mean, so much uncertainty. I remember the date, October 1st. So this is like a month or so after Lehman and like a month or so before Madoff. Like every day you turn on the news and someone was going bankrupt or there was a Ponzi scheme or something. And it was just, it was an insane part of the time market. But yeah, that's kind of where I started, and then went into some small commercial properties a couple of years afterwards, and I self-managed all the properties for 6 years. And since moving down to Florida in 2012, I had some professional property managers take care of all my properties in Connecticut, and I sold that whole portfolio to a investor out of New York in 2022. And I've been focused probably over the last 6 years on larger multifamily properties and syndications we've been involved with since 2018.
Awesome. Well, that is an amazing story. I think it's great that you were able to do that. Something growing up in environment with your family, you learned a lot. Probably taught you a lot about the value of investing in real estate and the appreciation over the long run. And you also got to see what it was like to self-manage, work on those C minus or D properties. And then at some point, you made a decision and something happened and you got into what's called syndication of multifamily deals. So two questions there. What was it that was the genesis for that transition? And then two, can you explain multifamily syndications versus what you were
Mhm.
doing before? And maybe you can start with the
Yeah.
first one,
Yeah.
multifamily syndications. Yeah.
Yeah, it sounds more difficult or more in depth and complicated than it really is. But syndication in general is so multifamily. So we're buying apartment complexes, and my first one was 59 units. And what syndication is there's two parties in syndication. There is a passive arm, which we call limited partners or investors or whatever it might be, and these are people that are just putting money into the deal. That's their only obligation after they verify the deal and do their due diligence and they wire their funds, their work is really done with the project. On the other hand, we have the operators, the general partners, the syndicators, key principals, all these people are kind of put into this side over here. And that's the active side. And they are doing everything else from finding a market, finding a property, building the team out, the brokers, reviewing hundreds of deals, buying one of them, putting together a package, managing the deal once it's purchased, raising money beforehand, and then, asset management, the whole nine, everything. And then what happens at the end of it is that those proceeds are split between the past investors, with them getting the majority share of it, usually 80% or 70% of the deal, and with the active managers getting 20 or 30% of the profits of the deal after a certain amount has been reached, which is usually 7 or 8%. So what it means is that it doesn't guarantee, but it sets the past investors getting a set amount of that 7 or 8%, which we call a preferred return, and then we split it above. And this allows the passive investors to do it best what they do, which is make more capital to invest into deals, and for the active investors to do what they do best, which is everything the whole laundry list of all the things, dozens and dozens of items that you have to do before actually purchasing one property. And it's a lot, but I'm on both sides of it with different deals, and you can always see, why it's such a powerful business model that's really been around for hundreds of years in different capacities in different industries.
Well, I love your explanation there of the syndication part of it. And so saying this back a little bit different is um, there's a couple different ways you can buy an apartment complex, and that is you take your own money. Of course, you can buy all of it cash. You could do that, but why would you when you can have the bank involved and risk most of their money rather than most of yours? So you can do that, and that is depending on the amount of capital that you have. You're probably going to be like what you mentioned, and most people I meet that are in that situation, a twoplex, a threeplex, a fourplex, maybe something as large as 10 units, but then you kind of get stuck at that point just because of the capital restrictions. And then on the syndication side, you're pooling resources together. And then you can, because you're pooling resources, and one of those resources is money, you can buy larger properties and you can have economies of scale.
Yeah.
So you were the way you grew up, the what you learned and what your dad was doing, how you started was you started with your own money. You mentioned house hacking, and then you went into the syndication part. So, um, what was your learning process like? How did you go? Why did you even make that decision? Like, I want to just close the chapter on doing this with my own money and just doing it all on my own, and to going into the syndication model.
I had a mentor, I believe it was 2016, 2017. That was like the only way you're going to be able to grow is by taking other people's money. I was for so many years just like, I'm going to, make money. I had an online business that I was working on full time at that point. And, that's how to make money. I invest into real estate, make money, invest into real estate. And then it was like, the only way of really, because my real passion is multifamily investing. I love the asset class, and it's very straightforward once you understand it. It's not wealthy overnight, but it's wealthy over a decade type thing. And it's something where it's obviously proven too. So with that being the goal of buying more properties, really the only way of doing it was to take investors' money and get into that whole syndication route of now we're not just looking for deals, we're also now we have another, kind of plate to spin too, which is also finding investors and working with investors to buy properties that we're already investing into and see if they want to join us in those.
And how has that decision changed your life and the trajectory that you were on and the trajectory you're on now?
Being involved with syndications on both the passive and active side of it has, I mean, it's really a game changer because it's real estate. Yeah, I will, I own property now that 100% myself and stuff like that still. But when you're working with passive real estate investing and with good operators, and you get money that's coming in consistently, and then you see deals sell, and there's a ton of work that has to be done to buy and sell deals. And when you're just getting emails saying this has been done, and you're part of the deal, and you're going to have part of that upside when there's profit, is a real powerful thing. I don't think people can 100% appreciate it unless they've purchased like investment properties themselves, done all the due diligence, done everything like that. I mean, all the things that need to be done. I mean, like when you're selling a property, I mean, the amount of hours it takes, no matter the size of it, everybody knows that's sold even just, their own primary residence, maybe. And I mean, the amount of work it takes to prepare that house or prepare that property for sale and dealing with brokers and dealing with buyers. So being able to have that done all passively opens up a whole new asset class to investors. And it's very powerful. You know what I mean? Other than just saying, I want exposure to real estate, I have to do it myself or put my money into REITs. And this gives you something where you're getting kind of the best of both worlds. In some sorts, it's not anywhere near as liquid as a REIT, but gives you the tax benefits. That's something that we REIT investors lack.
If you're enjoying the podcast and want to fast track your way to becoming a full-time real estate entrepreneur, then join the Multifamily Mastery Hub on School. You'll get access to our educational course library, live trainings, live interviews, and a community dedicated to helping you succeed. Visit school.com/multifamily mastery hub. That's SKOOL.com/multifamily mastery hub and fast track your way to becoming a full-time real estate entrepreneur today. Yeah, as you're saying that, the benefits of investing passively. So just a little bit about me and my background. The first investment property my wife and I had, we bought an old house, about 90 years old. It had been a rental for a long, long, long time, but the owner had done very little to it. So we said, let's buy it. We'll renovate it, flip it, and we'll live in it for a year or two. And then when we move out, we'll rent the house.
Yeah.
So when that was all going down, when the process started, my son was 2.5, and we had moved out of our house and there was still construction going on. We had crammed into my in-laws' house. And then around that point in time, my wife was pregnant, and then we needed more space because we had animals and everybody crammed into my in-laws' house. So we moved into this house where the construction wasn't done yet. And it was the whole, anyways, and I was very focused on my corporate career and taking calls early in the morning at my kitchen table with kids crying. And it was just like, oh my gosh, this is crazy. Anyways, so I got into passive investing at that point. And so I was able to change diapers and get mailbox money. It was phenomenal. It was like, this is the coolest thing ever. You mean I can be a real estate investor? I don't have to deal with the headache of chasing down contractors. Like, I don't have to find anybody to like fill a house. All I have to do is I got to educate myself a little bit. Like you mentioned, I got to do my due diligence. I got to understand enough about the investment. There's risk to it. But if I can do a little bit of education, and then I'm not doing all of this amazing amount of work that goes along with it. So when you were describing that, I'm like, oh yeah, that's exactly the pain I felt. Was like, this is not sustainable, but how do I still do this? And then there you go, the power of passive investing in real estate. The benefits of real estate investing without really having to do any of the work.
Right. Exactly.
Yeah. So now there's a lot of people who want to get into their first deal. And we spend a little bit of time talking about passive investing. We could spend more time. We'll circle back around to getting into your first deal as a passive investor. But what if someone wanted to get into their first multifamily deal? What advice would you give them? Like, what would that process look like for them? That's a challenging thing. You don't know what you don't know. How do you get into your first deal?
For being an active investor.
Being an active investor, how do you get into that first deal?
Um, it's a process. I mean, it starts number one with kind of having setting your goals and figuring out what you want to do. Because if we're going to buy one property, I mean, what is the end goal of what we're doing? Because it's going to help us define our plan of what we're doing. So once we figure that out, then it's really defining markets, building a team. Once you're building, I mean, it takes many, many hours. Knowing that team, and then figuring out exactly the specific area of that market, like the neighborhoods and everything, really that detailed to where you want to be buying. And this is going to help you when you're building a team and speaking to brokers and the whole, everything goes with it. Because if you're just like, I want to buy in this city and you talk to a broker, right? And they're like, okay, well, we're not going to take you seriously. But if you tell them this neighborhood, this part of the city, this area, the more exact you get and saying that, oh, I've reviewed some of these properties you've sold, these two are like what I like, or this other one is what I like this would be something I'm interested in. And you're like showing them you're doing research and you know exactly what you're doing, even if you're not physically in that area. That's going to move you up on that list of getting deals. And that goes with everything. That goes with dealing with your lenders. That goes with dealing with everybody else, property managers that you're working with. And then you start reviewing deals. And I mean, you're probably looking at 100 plus deals, depending on the type of properties you're buying. Possibly less if they're smaller properties because there might not be, depending on how you're sourcing them too. If you're going direct to owner, you might be looking at more. I mean, it just depends on the amount of time and how you're buying properties. And then after you do that, I mean, you're buying the property. So we're buying the property. We're most likely doing renovations to the property. We're renting the property, or we are turning residents, and then as we're renovating the property, depending on the size of it. And I mean, possibly handing that off to a property manager. And that would be what I would suggest as like one of the ways of doing it. And then the next time you've done all, the majority of that work already. So now this goes back to like the plan that we had already set up. So our goal was, hey, I want to buy 20 units, right? You just bought five. Now you're going to look in the same area. You've already done all your due diligence here. You know how it works. You know the mistakes you made. So maybe that wasn't the best area. Maybe you have to go move a little bit more this way, but still as close to the property as possible for management. And then you can buy your next one. And I mean, it's a plan that works. But the thing though is that there's going to be a lot of mistakes you make during the way, like anything. And it takes a lot of time to prepare yourself to start investing. I know people are like, oh, just buy deals and everything else will kind of work into it. And I understand that, but it's also, I wish I was a little bit more methodical when I started and kind of really put together a strategy of what my actual goal was. Because that's how I was as an investor. I think like most people are, it's like, oh, there's a good deal. There's a good deal. This thing's way over here. This is a good deal. And I was lucky enough to kind of like hone that in more. And I bought all my properties within like a mile radius. But other people I've spoken to before, I had a mentor, and then he's like, "Oh yeah, one's an hour this way, one's an hour this way," and you're like, "Oh, that's nope, and nope." And so you just knowing that plan going in, or if it's just like we're just buying two places, we're going to pay them off fully, and we're just going to live on that income. Okay, that's a different story. You have a different plan for that versus I want to buy 50 units.
Got it. So lot to unpack there. I'm gonna go back to you mentioned partners
Mhm.
on finding a deal. You mentioned market, finding brokers, goals in what size deal, what's your criteria as far as like what type of residence, property. There's a lot that goes into that. But you don't know what you don't know. How does one go about finding partners for their first deal?
Um, it's
Because let
networking.
me qualify
Yeah.
that a little bit. Um, if you can find somebody who's done it before,
Mhm.
it's going to shorten your learning curve tremendously. Now, you're still going to make mistakes along the way. Like that's just part of the learning process. But so if you can find someone who's done it before, like that's going to save you. And if you're getting investors' money, going to save you and your investors a whole lot of losses on monies potentially. So how would someone go about A, finding someone who's done it before, and then B, finding the right partners who have done it before?
So there's a couple different ways about this. It's networking, but it's also, I think, I would also find a mentor of some sort. And it doesn't have to be in the traditional way of maybe paying for a mentor or whatever it might be. But if you can find people that have already done it, the problem is that people that have that have done syndications before successfully, they have a lot of people that reach out to them, and they're very busy people. And this is like with anything that's been successful in business. You know what I mean? You're reaching out to someone successful and be like, "Hey, teach me everything, or I'll work for you for free," or something like that. And those people say that stuff, and I've never seen that really work, because people that I've heard that have had people come up to them, and same thing with me, people fizzle out, and it's also a lot of work for me to have you work for free, because if I'm, you know what I mean, because I'm really teaching you.
Mhm.
So if I don't have that, I can just pay someone else and save my time from doing it. So the paid mentor route is a good way of going. Once you have kind of goals set up, I think the networking works, and speaking to a lot of people that have the same goals that you do and the same kind of trajectory of what it is. The first property I bought, I remember when I was at the closing table, and it was a little delayed by an hour or two when we're sitting there. And I remember the guy selling me the property, him and his partner were there, and they were saying that one of the big mistakes they made in their, it was with one of the guys saying that about their property, was that when he started, and it was before this partner, he had an older partner, and he goes, it never worked because we had such this age gap. You know what I mean? So he had the money, and the guy was like 30 years older than him. This guy was buying the property from at that time was 20 years old, or some 25, whatever it might be. So they didn't have the right kind of goals of what it was. You know what I mean? One person was very hungry of moving forward. One person already made a bunch of money, and that's just trying to like have it work for them. So going through and networking with people and making sure that you're on the same page with what you're doing, types of deals you want to do, how long you want to hold them for, making sure you have complementary skills, which is a big one, but difficult, because you meet someone, you probably like them, you probably have the same skills. You meet someone you don't
Mhm.
like them, you probably have you probably have different skills, which will help to Monday. You know what I mean? This person's
Yes.
very
Yeah.
analytical. This person's an outgoing salesperson. You know what I mean? And that salesperson can also know some things about money and or about numbers and back and forth. But knowing someone that's really into those numbers, and you can give them, I'm literally forwarding them a deal and they're reviewing it quickly and letting me know like what's happening with it, where I would take me, the other person hours and hours, right? So I think that's the big thing about it, is being trained, like whatever it might be, and then also doing a lot of networking to find people that you can partner with that have similar goals, similar markets, properties, all that kind of stuff. And I think that's what's going to help you move your property buying, your syndication business along faster.
What are the so I'm writing notes down here, like in steps. So you mentioned get a mentor. I was going to ask you before you even mentioned it, the power of a mentor. I agree with you is huge with
Mhm.
something like this. I mean, it's very doable, but there's so much to it. It's such a big animal that if you're going to be active in the space, it's worth my opinion, it's worth the investment of an investor or of a mentor. It just is a really important piece of the process. If you're going to do it and do it right, yeah, it's find a mentor. Do your due diligence on the mentors, but get a mentor. And then you mentioned, and I'm right here, step two, find the right partners. So once you're starting to learn, finding the right partners, it's a team sport. Is that fair? Would you agree with that? It's a team sport. You got to find the people who you need to learn what you're good at and what are your gaps and and how can those people fill those gaps so that you can round out the team. What are the in your strategy for apartment investing, what are the skill sets or pillars, if you will,
Mhm.
of those partners?
Oh yeah, that's a great question. Yeah, there's there's really two parts of it, because we're doing two separate things at the same time. When we're finding deals, we're reviewing those deals, and then we're also like courting investors over here. And I think what happens best in this situation is that you're going to have mainly two people. I mean, as two kind of mindsets, and as your business will get bigger, you'll probably add more on there as there's more facets to your business. But really, number one is that you have to have someone that's analytical, that's going to be able to underwrite the properties and not spend, 5 hours underwriting every property, but really, hey, this is like 25 minutes. This is what it is. You can go back to the broker, and this is what we found, or 45-minute review. And then, because you're going to be going through so many deals, and you have to know exactly what has a chance of moving forward and what doesn't, and really shortlist the ones that can do that. On the other hand, you're going to need someone that's a little bit more outgoing. Maybe that person is making the broker relationships. That person's the one going out, speaking to them on the phone, going to the coffee, going to lunches, speaking to investors, right? And both people should always be raising money. I would think if one partner is only bringing money to the table and one's not, I'd be a little weary. I mean, both people should bring their own money to the table, and I think both people should be bringing their own investors to the table. Obviously, the outgoing person's going to have a lot more of that investor money and stuff like that, but it shows kind of an alignment of interest more on that end. And then I also think, for when you're starting off, spend time and really ask the hard questions with that person. And because there's deals I've done before with investor or with partners, and you're like, it was good, but it's not like, this isn't a partner that I want to like build a whole company with. You know what I mean? We did this deal, it closed well. We did another deal, it was fine, but like we have a different work ethic. So like you can partner on deals initially, and you have to do a lot of due diligence for that because these are going to last 3-5 years, maybe more. But the thing that was that before you're really combining forces and doing your own company together, I mean, these are kind of some of the important things. And that's what I found, making sure that you have those two people on the team that can really help, and those are really required to kind of help move everything forward to buy properties.
Got it. Okay. So you have someone who's more comfortable digging into the deals, doing a lot of the analytical work on the deals, will cross their T's and dot their I's in a sense. And then someone who's can spend more time on raising capital. You need, and I keep envisioning this Venn diagram where you've got overlap. You got to have overlap there, but you also have like your key areas where you're focused. Hey, thanks so much for sticking around with us today. Today's episode, we covered quite a bit of ground. So we actually broke it into 2 episodes for you. So come back next week. We're going to cover part 2. Thanks for tuning in to the Stephen Lee Thomas Show today. And if you found value in today's episode, then I have a favor to ask you. Please share it with friends, family, and anyone who might benefit from the insights we shared today. Also, don't forget to subscribe and leave a review if you enjoyed the show. And if you aren't already part of our school community, then head on over to school.com/multifamily mastery hub and join today. And again, thanks for tuning in, and I look forward to connecting with you in our school community.